Hello and welcome to the Capital Markets Live. I'm Alvin Lam, Managing Director of International Markets at Ginnie Mae. Today I'm joined by Vipul Jain, Managing Director and Head of MBS Trading Debt Strategy at Mizuho Financial Group. Vipul has 20 years in financial sector experience. He started with the Bank of America Merrill Lynch, then Morgan Stanley, Wells Fargo, Credit Suisse, and then last year he joined Mizuho. Vipul Jain has been a longtime friend of Ginnie Mae, attended many of our events, including the Global Investor Summit. We really appreciate many of your insightful views on various aspects of MBS market, such as relative value, prepayment, housing finance, residential lending, and policy. So glad you can join us today, Vipul. Happy New Year.
Thank you, Alvin. I'm really happy to be with you and share some of my thoughts. And obviously, these thoughts are mine. So happy to kind of answer any questions that you may have as you think about 2024.
Great. We certainly like to have a very happy New Year. Would you like to share with us your first, the outlook view in 2024? We can start with the Federal Reserve. The street has a lot of discussions lately on Fed's movement. What is your outlook for the Fed, and what does it mean for the MBS market?
Yeah, that's a great one. And obviously, that remains one of the biggest questions for the MBS market. I think if we think about last year and a half, pretty much most of the discussion in the MBS market has largely been driven by the macro policy. And still remains the same for now. At this point, I would say it's fairly clear that Fed is done hiking rates. Uh, Given where we are, we expected a lot more consensus in the market regarding Fed outlook at the end of this hiking cycle. However, when we look at the 2024, we see wide range of potential outcomes for the Fed fund rates. Mizuho economists remain more hawkish than market consensus as they expect inflation to remain sticky. In any case, we anticipate the impact of monetary policy tightening to be felt and economy to weaken in 2024. With this change in outlook, especially since the last FOMC meeting, there are two fundamental changes in 2024 relative to 2023 that we need to keep in mind. 2023 was a volatile, trending market where investors were afraid to take duration risk as they kept losing money on their purchases. With the Fed pivot, what we see is that investors are becoming much more willing to take on duration risk and are not as worried about tail scenarios such as large sell off in rates. We expect rates to stay volatile as we remain data dependent, but the tail risks definitely have come down. This change in sentiment should bode well for MBS demand from banks and overseas investors, which were largely absent last year. Furthermore, if the Fed decides to stop shrinking the balance sheet earlier than expected, the pressure on bank deposits will ease, which has been a big issue in 2023, and that also should be constructive for bank demand this year.
That's a good outlook. Appreciate that. Let's touch on some of the fundamentals. Home prices have remained very resilient despite high mortgage rates. Where do you think the price will go in 2024? Up or down or staying?
Yeah, Alvin, that's a great question. Housing market in 2023 was very perplexing to us. Like initially, when we came into the year, we were very concerned about affordability due to high mortgage rates. And despite this poor affordability, the lack of inventory really carried the day and remained the single most important driver for the housing market. We expect that to continue because if we look at the inventory, it still remains very, very low. However, there are two things that are going to happen because of the Fed monetary policy. One is we expect both economy to slow and we expect inflation to be lower in 2024 compared to 2023. And both those factors should ease the rapid HPA that we saw. It was almost over 6% in 2023. We expect it to be more modest, but still stay positive. So our baseline forecast for 2024 is HPA of 2 to 3%, especially as the economy weakens.
Yeah, thank you for sharing that forecast with the affordability in mind, which is one of the important policy that Ginnie Mae and than housing and urban development has. I want to get more details from your thoughts. How are you thinking about supply demand technicals in 2024? Do you think banks will make a comeback?
Yeah, that's I guess number one question on everyone's mind. 2023 was very challenging because pretty much most of the investors were either not involved or letting their portfolio run off, including the Fed. It was a very one-sided market with money managers as the primary buyers in the market. When we think about 2023, as far as the supply side of the equation is concerned, we expect it to be very similar to 2023. We are expecting 200 billion in net issuance of MBS and another 225 billion of Fed runoff, which in total is close to 425 billion, similar to what we had in 2023. And I would say there's, in general, very strong consensus among market participants around those supply estimates. However, when we think about demand, that's where you see a lot of different views, and I'm happy to share mine. When we think about banks, as I said, they remain the number one kind of factor in our thought process for next year. Uh, One of the big challenges for banks was that they kept on losing deposits in 2023, and big part of that was QT, and obviously the deposit rates they were offering to consumers remained much lower than what consumers could get elsewhere, like in T-bills and things like that. So we expect that to remain a headwind for banks, at least in the first half of the year. Um, but when we look at the securities portfolio of banks, they have continued to run it off. And at this point, it's close to 30% when we look at loans and securities. So securities are 30% of loans plus securities in their portfolio. During COVID in 2021, that was as high as 36%, and pre-COVID average was close to 28%. So we're getting close to that steady state level. In another quarter or so, we think we'll be at a level where banks will be ready to add again. Obviously, the two things that I mentioned from the Fed outlook, I think, are still going to be a real catalyst for banks. Uh, Both banks and overseas investors have, as I mentioned before, become much more comfortable with the duration risk. And we think that will get them back in the market. We expect banks to add 60 billion this year and overseas investors to add 75. Um, the other thing that can help with the bank demand is if the Fed decides to stop running off its balance sheet sooner than expected. Originally, we were expecting it to for them to end that at the end of the year. But given the recent discussion, we expect it can end as soon as middle of the year. And then when we look at some of the other players like REITs, REITs can be marginally additive as the price to book for them is above one. And overall, we expect money managers to still remain a big player in the market. Um, and and that remains kind of a delicate balance in the MBS market.
That sounds some good positive news here. Um, you mentioned earlier at the beginning that the Fed has done with the interest rate hikes. How do you think prepayments will evolve this year?
Yeah, so I think the prepayment side of the story is very interesting. Obviously, last year and a half, pretty much most of the mortgages were deep out of the money, and it was about turnover. But over the past year, with the almost close to $1 trillion in issuance, there is a substantial amount of mortgages which will be refinanceable given the rally in rates that we have seen. Um, so I think when we think about the recently originated mortgages that will go in the money, um, we think that the speeds on those, especially on the conventional side and including the Ginnie side, we could see speeds that we saw in 2020 and 2021, which means almost 45, 50 CPR once some of these higher coupons get 100 bips in the money. However, when we think about loans that are still deep out of the money, I think at this point we have almost a year of history. We expect those loans to kind of maybe inch marginally higher as they season and life events happen on them. And then also the other thing that we can see is that as rates are rallying, so the lockout should ease also somewhat. But again, that shouldn't be that big of an effect all in all, we could see some of these lower coupons, the speeds could increase by up to half a CPR compared to what we saw in 2023.
With all your comments, the Fed actions, housing price, supply demand fundamentals, prepayment speed, let's summarize that. What is your outlook for mortgage for this year?
So over the past month, along with other risk assets, MBS have done very well as investors have started pricing in aggressive cuts from the Fed. As I mentioned before, supply and demand technicals are likely to be more balanced in 2024, and money managers are still a dominant player. We believe that money managers may become a little hesitant to add at current valuations. Therefore, in the first quarter, we could see some give back of some of the recent gains. However, we expect the environment should get better during the second half as the Fed outlook gets better. Overall, we don't expect mortgages to tighten as much on an OAS basis, but we can see them tighten on a nominal basis if interest rate volatility comes down. So it's more of a wall trade rather than the OAS trade.
Well, certainly there are a lot to look into this year. We hope to get you back once a while to keep us updated on your forecast. So thank you, Vipul, for very thoughtful information views on the future market. Really appreciate the time discussing the 2024 MBS Outlook.
Thank you, Alvin. Very happy to be here and happy to come back whenever time comes. And thank you, everyone else, for listening. Really appreciate your time.
Thank you. For the audience, if you enjoyed this podcast, please be sure to subscribe our future episodes of Capital Markets Live on YouTube. If you have any comments or questions about today's episode or other topics, please send us an email. Our email address is ocmglobalinvestorinquiries@hud.gov. Again, the email is ocmglobalinvestorinquiries@hud.gov. Thank you for listening and talk to you soon.